So, what happens when a company is actually successful and makes a bunch of money? It sounds like a good problem to have, right? But it leads to one of the toughest choices in business. Do you take that cash and build for the future, or do you reward the people who own the company right now? Today, we're going to dig into a theory that has a very strong and, sometimes pretty controversial opinion on this. And this is the question, right here. What comes first, growth or dividends? Imagine your company just had an amazing year. Do you hand out cash to your shareholders, a dividend, as a thank you? Or do you take all that money, plow it right back into the business, and bet that you can make it grow even bigger? It's a fundamental question, and it really gets to the heart of a company's priorities. This whole situation creates what you could call the dividend puzzle. It's something company leaders are always trying to solve. So in this first part, let's unpack what that puzzle really looks like. At its core, it seems pretty straightforward, but it's this constant balancing act. On one side, you've got reinvestment. We're talking funding new projects, expanding, R&D. Basically, all the stuff that's supposed to build value over the long haul. But on the other side, you've got your investors. They're the owners, and a lot of them really, really like getting a steady, predictable check in the mail. So how do you even begin to solve this puzzle? Well, there's one very logical, very management-first philosophy that offers a super clear answer. Invest first, pay later. Let's get into what that actually means. And here's the textbook definition, the Residual Dividend Theory. It basically says that deciding on dividends isn't the first thing you do, it's the last. The company's #1 absolute top priority is to find and fund every single project that it thinks will make money and grow the business. Only after all of that is taken care of, only then does the company even think about paying a dividend. Dividends are the leftovers, the residual. This quote just nails the philosophy behind it. According to this way of thinking, the real value, the new wealth, gets created when a company makes smart investments. Paying a dividend? Well, that doesn't create anything new. It just moves money that already exists from the company's bank account into the shareholders' bank accounts. Yep, here's the simplest way to remember it. Think of a company's profits like a big pie. Before anybody gets to eat, the company first takes all the slices it needs to bake an even bigger, better pie for next year. Dividends are just whatever slices are left over after that. Now, this isn't just some abstract concept. It actually breaks down into a pretty clear formula. So in this next section, let's see how the math on this really works. The whole process follows 4 simple steps. First, you figure out how much money you made, your net income. Second, your team identifies all the good, profitable projects you could possibly sink that money into. Third, you take your income and set aside enough to fund the company's share of those investments. And then finally, step 4, whatever's left, that's what you can pay out as dividends. Theory is one thing, but seeing the numbers makes it click. So let's just walk through a really simple example to see this in action. Okay, so let's say our company had a killer year. We've got a net income of £10 million. That's the total pot of cash we're working with. All right, now the management team has scouted out some fantastic projects, maybe a new factory or R&D for a game-changing product. All in, they need £8 million of equity to make it happen. So that money comes out of the pot first. Remember, growth is priority #1. And there it is. After we've funded every single one of our profitable growth ideas, we're left with £2 million. That is the residual. That's the money that's now free and clear to be paid out to the shareholders as a dividend. It's really that straightforward. So this all sounds perfectly logical, doesn't it? Fund your best ideas first. What could be wrong with that? Well, in the real world, it's not quite so simple. It turns into a pretty serious balancing act with some major pros and some major cons. And right here, you can see the trade-offs clear as day. The advantages from the company's perspective are awesome. You get to maximize growth, you use your own cash first, which is great, and your spending is perfectly aligned with your strategy. But, and it's a big but, the challenges are all about how it looks to the outside world. Your dividends could be huge one year and zero the next. That can really spook investors. It might signal instability. And the whole system depends on being able to perfectly forecast your investment needs, which, let's be honest, is practically impossible. And that really brings us to the core conflict here. On one side, you have this cold, rational, almost machine-like approach to making the company as valuable as possible. And on the other side, you have us, the investors, the human element.
We often just want a predictable payout that we can count on, year in and year out.
Okay, for our last section, let's see how this theory actually shows up in the real world. Because once you get this residual idea, you'll honestly start seeing it everywhere. This is where it all comes to life. Think about a young, hungry tech company. It's got a million ideas, endless opportunities to expand and innovate. It follows the residual theory perfectly. It reinvests pretty much every dollar it makes, so its dividends are tiny if they even exist at all. Now compare that to a big, old, mature utility company. It doesn't have a ton of new places to grow, so after it pays for basic maintenance, there's a huge residual left over. And what does it do? It pays that out in the form of big, stable dividends. So, let's just quickly wrap up the key points. With the residual dividend theory, investments are always priority number one. That means dividends are simply what's left over, the residual. Now, the whole point is to maximize long-term value, but the side effect is that those payouts can be really volatile. And maybe most importantly, this theory gives us a fantastic way to understand why a tiny startup and a giant utility company behave so differently with their profits. And that leads us to the final question, and it's one for you. As an investor, what do you prefer? Do you want that steady, predictable payout you can hold in your hand today? Or are you willing to bet on the promise of a much, much bigger prize down the road? It's a choice that really defines what kind of investor you are. Thanks for tuning in.